Brian with the first quarter 2023 update. And remember, at Leelyn Smith, we try to reach client goals with the least amount of risk possible. This video is going to be a little bit different than our typical video where we have just a topic that we cover. This time we're going to look at 2022, 2023, and then we're going to cover our topic, which is staying invested. So let's jump in. So 2022, at the beginning of 2022, the Federal Reserve expected 0 to a quarter point of rate hikes as the economy got away from the COVID era and the stimulus era. And inflation turned out to be anything but transitory. Now, there were some extenuating circumstances in addition to all the stimulus packages, which was the Russian invasion of Ukraine, which caused some inflationary pressures on energy and some grains, in addition to the global turmoil that created. And China's zero COVID policy led to a slowing of the healing of supply chains, and that a supply chain being less than 100% is inflationary in and of itself. And as inflation was high, the Fed reacted by raising interest rates, and as interest rates are risen, that decreases over time the future value of earnings that companies may be generating. That's what happened in a nutshell. Now, 2023, the Federal Reserve is not yet done fighting inflation. However, it does look like we're past the bulk of the interest rate hikes, which is good news. Until there is evidence, though, that the Fed is satisfied with where inflation is and where interest rates are, the markets will probably be volatile and possibly even go down a little bit further from here. There are some silver linings, though, and those are, number one, like I mentioned earlier, it appears that we're past the bulk of the rate hike regime. Good news there. Number two, because of these higher rates, bonds are actually paying better than they've had in years. So you're going to get some decent yield out of bonds. We like short-term, high-quality bonds in that space. Third, stocks are trading at a deep discount per Morningstar, and those discounts don't last forever. So that leads us to the topic that we're covering today, which is staying invested. And should I stay invested? Now, every client situation is different, and we create a custom plan for each of our clients. But the short answer to that is yes. Now, that depends on your risk tolerance, your plan, and so on. But here are other reasons why. Number one, the companies that we invest in and the investment strategy we use, it identifies those strong companies at a good value. And you don't ever want to be out of those companies. Number two, the best days in the markets occur near the worst days of the markets. It's kind of a paradoxical situation. And the longer you stay invested, the higher your probability of positive returns becomes. Last thing I want to mention is, we've mentioned this before, it's the biggest risk of investing. It's our behavior. And exiting during market downturns is one of the biggest risks. Looking back at the financial crisis, which was a much worse time than right now, puts this into perspective. You can see here how going to cash and staying in cash just basically guaranteed the loss. So 2022 was volatile, and 2023 will have challenges, but there appears to be light at the end of the tunnel as we get through this restrictive monetary policy. If there's anything to remember from this video, it's that there will always be things to worry about, right? There's always something to worry about in the market. Keeping that in mind may help you ease your investing fears just in and of itself. That, plus having a financial plan, referencing it, and consulting with your financial advisor should help. And also, remember that the economy runs in a cycle. As the business cycle slows, which it is doing right now, it will eventually get out of that period and resume its climb. And 3 out of the 4 phases of the business cycle are expansionary. All right, thanks for watching. Keep an eye out for our next video. And remember, at Leelyn Smith, we try to reach client goals with the least amount of risk possible. Thanks for watching.